Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun of the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit in current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference. 800-306-1990, 800-306-1990. And yes, of course, we're celebrating today, but only in moderation, because today is National Nutty Fudge Day. And yes, I do like nutty fudge, but it's really not such a good thing for the diet, or the way of life, I should call it. Not National Nutty Fudge Day. Josh, that looks like brownies. That doesn't look like fudge. Okay. I should say anything because I have absolutely no artistic talent. But, something nutty fudge. I usually think of fudge as being something we're getting, the fourth quarter, not usually in the spring. Is fudge a spring? No, yeah, Josh, I'm not losing it completely, I guess. So Josh is saying the same thing. It's a fourth quarter item. I don't know. I guess there was nothing else to eat today, so they put nutty fudge on there. I wonder if there's some logic. I wonder if there's something that's going on behind the scenes that we just didn't look at and see why they call it, why they're doing it now. Hard to say. It's hard to say. Nothing really strikes me that says, okay, maybe it's just that people want to think about, it's not even Amazon's, what is it, Christmas in July or something? Isn't that July that they do that? Yeah, so it doesn't even fit for that one. Okay, let's move right along. It's also National Fibromyalgia Awareness Day. So why do I bring that one up? Well, if you take a look, we actually did a white paper on some of the peptides for fibromyalgia. If you go to rsrlinks.com/aminopeps, rsrlinks.com, throw a curveball at Josh right there. I think it's rsrlinks./amino, and I don't know if it's plural or not. Let's see if I can get it right. Yeah, rsrlinks.com/aminopep, I believe it is, Josh. Might try that before we even share it, but we did a white paper. There are some studies that there are some peptides that have shown some promise for fibromyalgia. And why do I bring that up? Well, what is a peptide? It's nothing more than a chain of amino acids. No, I'm not a doctor and I don't give medical advice, but it's a chain of amino acids that kind of wakes up your body to do the things it's supposed to be doing. Now, a lot of us get to the point we say, okay, I'm 60 years old. I guess I have to do the math, 63. So I'm 63 years old. You have to say, okay, well, the body's going to break down. It's not going to do the things it did. But peptides basically say, hey, why not? Why not wake up that body? Why not get it doing some of those things that it did 10, 20, 30 years ago? Something, I don't know. That's the peptide world. So do your own research. If you have questions about some of the things that are in that world, I've done quite a bit of studying on it. I can share what I know. Again, not giving any medical advice, just sharing my knowledge. Let's see what the markets are doing today. They're probably not the nicest looking markets in the world, but it's not too bad. Dow Jones Industrial Average is down 196 points. The NASDAQ, whoa, the NASDAQ is way down. That one's not doing good, but the NASDAQ is down 408 points. Ow! S&P is down 62. Oil's up $3.50 a barrel, 101.53. And gold is down $65 per ounce right now. Wonder what's driving all this? Well, I'm going to tell you. Treasury, the 10-year Treasury is up 4 basis points, 4.45 right now. It's all got to do, there's two things that are driving the market today, and it all stems off of one. It's all got to do with oil. It's all got to do with the Middle East. And the fact that we've got the oil issues pushed core CPI and all of our CPI numbers way up today. And that's what's really driving this whole market. Now, you know, I'm going to share my opinion based on nothing other than being a news consumer. And again, I tell you that, you know, you can't go to the mainstream media and get any kind of real news. They're going to tell you what you want to hear. Go to Fox News, they'll tell you what they want you to hear, what you're looking for from the right, and what the president wants you to hear. Go to CNN, they're going to tell you what the left wants you to hear, all of the anti-president stuff. So where do? You have to pay for your own news services. That's what I do. So I have 3 or 4 or 5 different services that I use. I go there, I pay for those services. That way I can vet them. And, you know, if they go off topic and they start giving me their opinions without telling me its opinion, well, then I just cancel my subscription, and they understand that that's the business they're in. What is the business of most media? It's very, very simple. It's to deliver your ears, your eyes to the commercials. That's how they make money. When I talk to folks and our private clients, I constantly tell them, if you're going to some of these credit sources, Credit Karma, Credit Sesame, all the others that are like that, are you getting real credit reports? No. What are they doing? They're trying to get you to click on the commercials, give you their names, like your names, so they can sell it to somebody else. That's what they're in business for. There is no such thing as a free lunch, except on Ron Siegel Radio. So the bottom line here is you got to pay for your own news. Now I'm going to share with you that, you know, we're not going to see anything new for the next couple of days. The president's en route to China, or he will be shortly. He's going to be there for the summit for however long. I know the summit's on Wednesday, but that's what he's going to be going there for, is the summit with Xi Jinping. Not going to do anything while he's there. Now, when she was here during the first Trump administration, yes, there were some missiles that left while they were having dinner. Don't expect that to happen this time. Yeah, you know, you can only surprise me once, don't surprise me twice. But the bottom line is I think right after that, you know, I think some of those people in Iran might be wanting to check on their insurance policies to see if their life insurance is up to date. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, equity isn't wealth until you move it. Most homeowners never get that memo. I used to wonder why gas kept rising. Then I learned this one truth about global oil pricing. There are 2 ways to buy a home in this market. Most buyers only see one, and 38% of families would be broke in 6 months if a paycheck disappears. Yours does not have to be. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel lending team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel lending team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Mortgage Minute today being brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry. Calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They do not tell us points paid, points received, or the APR. They tell us the number you put in your mortgage calculator to determine your principal and interest payments. If you don't have a mortgage calculator, we've got a whole suite of calculators and illustrators. rsrlinks.com/calculators is where you go to get them for free. Rates yesterday. Conventional 30-year fixed, 6.351. That was up. Jumbo 30-year fixed, 6.421. That was down. FHA 30-year fixed, 6.09. That was down. VA 30-year fixed, 5.973. That was up. And the USDA 30-year fixed, 5.925. That was down. If you want our thoughts about the market, join the Ron Siegel Radio community, rsrlinks.com/HBOD, rsrlinks.com/HBOD. What are the markets doing today? Let's look. It's a pretty simple solution. So we've got the S&P 500 is now down 58.5 points. 10-year Treasury is up 4 basis points to 4.45. And the mortgage bond, that's down 5 basis points. Bond down, rates up. Not a whole lot of movement right there. Now, you may hear and see from different sources that the bond is moving dramatically depending upon who you're listening to. What's the difference? Well, I like to watch the bond, and there's disputes or there's differences from people. Number one, I don't change the coupons on it very often. But I like to watch the coupon that's closest to par, which means closest to 100. So right now, that would be the 5.5 coupon, and it's only down 5 basis points. Now, if I was somebody that was following, let's just say that I was following the 5.0 coupon. Well, that one's a ways from par, so it is showing down 17 basis points right now. If I go the other direction and I go to the 6.0, again, that one is also a ways from par, but it's only showing up 5 basis points. So again, I like to stay with the one that's closest to par just because it has less volatility and it gives us good information. Not that the other ones are bad information, but I think the one with that's closest to par is the one that most of the lenders are going to be dealing with because that makes it easier for them to price and not have to be changing their pricing all the time. So let's take a look and see what's going on right here. Oil prices and yields. So we've talked about that. President Trump said the ceasefire between the U.S. and Iran is unbelievably weak and on massive life support. The U.S. is considering restarting combat operations, and the hopes for peace deal are hinging on a meeting with President Xi from China happening later this week. Also pressuring bonds this morning was a hotter than expected consumer price index inflation report, but the core reading was impacted by another anomaly in shelter. So we're going to watch that. We've got a bond auction, a 10-year Treasury auction coming up at 10 o'clock Pacific time. That would impact the markets depending on the level of demand. So if there's a lot of demand for it, that could be good for prices. That moves prices up. If there's not a lot of demand, then the prices go down. Consumer price index for April showed the headline inflation was reported at 0.6%, which was in line with estimates, but a hot reading. This is mostly due to the Strait of Hormuz closure Energy prices rose by 3.8%, and gasoline rose by 5.4%, accounting for over 40% of the headline rise, while food prices rose by 0.5%. The combination of energy and food accounted for more than half the rise in headline. Year-over-year headline inflation rose from 3.3% to 3.8%, which is 1/10 hotter than estimates. Most important core reading, which strips out food and energy, rose 0.4% in April, which is 1/10 hotter than estimates. Year-over-year core inflation rose from 2.6% to 2.8%, but the market was only expecting a rise to 2.7%. Shelter's been slowly moderating and helping the inflation readings, but it jumped 0.6% in this report. The government shutdown had an impact as they did not have readings previously, and they carried forward previous reading figures. Now that they have the readings, they plugged them into this month's report. So it's a bit of a double hit here, temporarily causing the readings to be higher and impacting the monthly core reading. Without it, the rise would have been 0.25% instead of 0.4%. Airline fares keep rising, mostly due to jet fuel, and jumped by 2.8% last month and 20.7% year over year. Ow! ADP released their weekly employment report for the week ending April 25th, showing that on average, there were 33,000 jobs created per week over the previous 4 weeks. This would portend roughly 140,000 jobs in a full month. The weekly readings have been a pretty good indicator of the monthly ADP employment report, so this is worth keeping an eye on as the month progresses to get a good idea of what we may see next month. That's the Mortgage Minute, brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. Let's take a look and see. I think we've got Your Credit Matters, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free. Here's a question that confuses a lot of smart people. If the United States is energy independent and we export oil to the rest of the world, why does the price at the pump keep climbing every time something blows up halfway across the globe? That contradiction is costing your family real money. Let me explain it. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. You've heard the headlines for years. The U.S. is the largest oil producer in the world. We export more energy than we import. We are on paper energy independent, and yet here in California, gas is over $6 a gallon. Ow! Across the country, prices keep ticking higher every time there is tension in the Middle East. Most recently, the latest peace proposal involving Iran was rejected, and right on cue, oil markets reacted. Prices moved, inflation fears jumped, and mortgage rates pushed higher. So what's going on? How can we produce so much oil and still feel pain at the pump? There are 3 reasons, and once you understand them, the whole picture clicks into place. Reason number 1, not all oil is the same. The oil we produce in Texas and the Permian Basin is what is called light sweet crude. The oil that most refineries are built to process, especially the ones serving California, is called heavy sour. So we're pumping the wrong flavor of oil for our own refineries. We produce light sweet, we export light sweet, and then we import heavy sour from places like the Middle East and Venezuela to actually fill our gas tanks. California alone imports about 1/3 of its oil from the Middle East. The last tanker from the Middle East just arrived this week. Let me say it differently. California, the 4th or 5th largest economy in the world, just received its last Middle East oil tanker. That is not a small detail. Reason number 2, geography is not on our side. You might be thinking, fine, just ship Texas oil to California. The problem is the Rocky Mountains. There's no pipeline running over those mountains, and there will not be one anytime soon. So even though Texas is closer than the Persian Gulf on a map, it is much harder to actually move oil from Texas to a California refinery than it is to bring it in by tanker. Nature decided that one for us. Reason number 3, and this is the big one. Oil is a globally traded commodity. The price is not set by what is happening in Houston. The price is set by global supply and global demand. So when 20% of the world's oil passes through the Strait of Hormuz and there is conflict around that strait, prices rise everywhere. Even if every drop of U.S. oil stayed inside our borders, the global price would still spike, and that global price drives the cost on Main Street. And one more layer. Countries like Germany, France, and the UK produce almost no oil of their own. When supply gets tight, they bid the price up to make sure they get what they need. And oil companies are private businesses. They are not charities. They sell to the highest bidder, not the closest neighbor. So when the world bids more, Americans pay more, even though we are sitting on top of the stuff. So what does this mean for you? It means your family budget is taking a hit on two fronts at the same time. Front one is at the pump, front two is in your interest rate. When energy prices rise, inflation rises. When inflation rises, bond yields rise. When bond yields rise, mortgage rates rise. The April CPI report expected to push year over year inflation. We talked about that already, and that's a big part of that bump is energy. That is not a number on a screen. That is a real dollars on your mortgage payment, your car loan, and your credit cards. Here's the truth nobody is telling you on the news. You cannot control the Strait of Hormuz. You cannot move the Rocky Mountains. You cannot force Europe to stop bidding on Saudi oil, but you can absolutely control how prepared your household is when these things happen, because they will keep happening. And that comes down to one thing: knowing your numbers. Most families I talk to have no idea what their actual monthly cash flow looks like, what their credit score is doing month to month, or what their assets are really worth right now. When inflation hits, when rates move, when gas spikes, those are the families that get caught flat-footed. The families that come through this just fine are the ones who know their budget, know their credit, and know their balance sheet. They are not guessing, they are tracking. That is exactly why I want you to grab the tools at rsrlinks.com/keysteps. It's rsrlinks.com/keysteps. I'll give you free access to a system that tracks your credit, watches your budget, and keeps an eye on your assets all in one place. So when the next headline hits, you already know where you stand. Go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Your Credit Matters segment, brought to you by rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, equity isn't wealth until you move it. Most homeowners never get that memo. And there are two ways to buy a home in this market. Most buyers only see one. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. When's the last time you actually checked how much equity is sitting inside your home? Not what you think it's worth, the real number. Because if it's been a few years, that number is probably bigger than you remember, and most homeowners have no idea what to do with it. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Here's a stat that stopped me in my tracks this week. According to the National Association of Realtors, the typical homeowner has gained roughly $128,100 in equity over the past 6 years. $128,100. from doing nothing more than living in their home, making the payment, and letting the market do its work. Now, that is the national average. Here in California, our numbers are probably closer to double that. Call it roughly 256,000 equity gained over those same 6 years for the typical homeowner in our market. And if you've owned your home longer than 6 years, the number is almost certainly higher than that, a lot higher. So the question I want to ask you today is, what is that equity actually doing for you right now? Because here's the part nobody talks about. Equity that just sits inside the walls of your home is dead money. It is not earning anything. It is not protecting you in an emergency. It is not paying down higher interest rate debt. It is not buying back time. It is just sitting there locked up, frozen, untouchable until you either sell the house or beg a bank for a second mortgage at a rate you won't love. That is where strategy beats rate always. Let me give you a generic example using the California number. Picture a family with a $650,000 mortgage balance. Over the past 6 years, they've built up another $256,000 in equity. That's $250,000 of net worth that did not exist for them in 2020. Their neighbor down the street tells them, just pay off your mortgage faster. Throw extra at the principal. Sounds smart, right? It's the opposite of smart. Because the second they shove that $256,000 worth of cash flow into the walls of their home, they lose liquidity. If the furnace dies, if a job changes, if a kid needs help with college, that money is gone. They can't get to it. This is why I look at 3 things with every family I meet: safety, liquidity, return, in that order. Most people obsess over rate. Rate is one number on one loan. What I care about is your household blended interest rate. That's the average cost of every dollar you owe, weighted across your mortgage, your credit cards, your car notes, your student loans. Drop that blended number, and you change your family's financial life. Change a quarter point on your mortgage, and you barely move the needle. So what do you actually do with the $256,000 in equity? Here's one option I share with families every single week. It's called the Wealth Builder Loan. It's a first lien HELOC that calculates interest on your average daily balance instead of the full balance every month. That means every dollar that lands in your account, your paycheck, your bonus, your tax refund, immediately goes to work knocking down what you owe. And when you need that money back, you pull it right back out. Full liquidity. The right family using this strategy correctly can pay off their home in 6 to 8 years without sending one extra dollar out of the household budget. 6 to 8 years, not 30. And without locking up a single dollar. Is this for everybody? No. This is where eligibility versus suitability matters. Eligibility means the bank will give it to you. Suitability means it actually fits your life, your goals, and your full financial picture. Those are 2 very different conversations. Eligibility is what a loan officer does. Suitability is what a certified liability advisor does. That is the difference. So here is what I want you to do. Stop guessing what your equity is. Stop letting it just sit there. And stop assuming that paying down your mortgage faster is the smarter move, because in most cases, it is not. If you want to see exactly what your equity could be doing for your family, go to getwealthbuilder.com. That's getwealthbuilder.com. I think I did that wrong, didn't I, Josh? It's rsrwealthbuilder.com. rsrwealthbuilder.com. I'll personally walk you through whether the Wealth Builder loan fits your situation, what your household blended interest rate looks like today, and what a real strategy beats rate plan looks like for your home. The conversation is over Zoom. It costs you nothing, and you walk away with a number and a plan, not a sales pitch. rsrwealthbuilder.com. Your equity is the largest asset most families will ever own. Let's make sure it's actually working for you. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Real-Time Real Estate segment, brought to you by rsrmoney.com, rsrmoney.com. Mortgage 101. Mortgage 101, brought to you by rsrlinks.com/keysteps. Most buyers are sitting on the sidelines right now, waiting for rates to come back down. And while they sit and wait, the price of a home in this country just hit the highest April number ever recorded. So who is actually getting the better deal here? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let me tell you what happened in April. The housing analysts were expecting home sales to bounce more than 3% from March. The actual number came in 0.2%. Yes, 0.2%, essentially flat. 4.02 million units on an annualized basis. Why the freeze? The 30-year fixed mortgage ended March in the high 5% range. Then the U.S. and Israel conflict with Iran kicked off and rates shot straight up. This week we opened at around 6.42%. That's the rate that scared buyers off the field. But here's what the morning news did not tell you. Even with sales flat, the median price of a home sold in April was $417,700. National average. It's about 1.2 million here in Orange County, California. That's the highest April price the National Association of Realtors has ever recorded. And here in California, you can roughly double that number to get a feel for where we actually live. So while buyers were waiting, prices kept climbing. How is that possible? One word: inventory. We have a 4.4 month supply of homes for sale, a balanced market, about 4 to 6 months. The chief economist at NAR said inventory needs to grow 30% from here, and we are nowhere close. Multiple offers are still happening. 25% of every sale in April was all cash. First-time buyers still 33% of the market. They are not waiting, they are buying. So what does this mean for you? It means the buyer who is sitting on the sidelines waiting for a 5% rate is also watching prices climb, inventory stay tight, and cash buyers grab the best homes. That buyer is fighting two enemies at once: a higher purchase price on the home you actually want, and a smaller pool to choose from when you finally jump in. Here's the conversation I want every listener to hear today. Strategy beats rate always. You do not have to accept the rate the market is handing you. There is a permanent buy-down strategy that nobody on TV is talking about. I am not talking about a 2-1 buy-down that lasts a couple of years and then drops you off a cliff. I rarely recommend those. I'm talking about a life of the loan buy-down. You pay points up front, and that lower rate stays in place for as long as you own that loan. Every month, every year. Let me show you what that looks like in real numbers. This is for educational purposes only and is not an offer to lend. Your actual rate and payment will depend on credit, equity, property, and lender, and not all borrowers will qualify. A buyer comes to me with a 6.5% mortgage, a $650,000 mortgage, at a 6.5% rate on a 30-year fixed. The principal and interest payment runs about $4,108 a month. Now we apply a permanent buy down to move that rate to 5.5%. The principal and interest payment drops to about $3,691 a month. That is roughly $417 of savings every single month, not for 2 years, for the life of the loan. Over 30 years, that's more than $150,000 staying in your pocket instead of the bank's. What does that buy down cost? In a market like this, plan on roughly 3% of the loan amount. On $650,000, that's about $19,500. So you're spending $19,500 once to save $417 every month for as long as you own that loan. That is real math. That is real liquidity protected every month. And here's the part most loan officers will never tell you. The seller in this slower market is far more willing to contribute toward your closing costs than they were a year ago. Days on market are up to 32 days. Sellers are negotiating. That seller credit can fund the permanent buy down. You walk in with a lower payment, the seller helps pay for it, and the home is still building equity in your name from day one. That is strategy. That is suitability, not just eligibility. Eligibility is whether the bank says yes. Suitability is whether this loan on this property at this moment fits your wealth plan. Safety, liquidity, and return. That is what a certified liability advisor does. That is what a typical loan officer cannot offer you. And let me say this part one more time because it matters. Strategy beats rate always. The rate is one number on one piece of paper. The strategy is the difference between owning a home and owning your future. If this is the year you want to stop renting your future and start owning a strategy to go to strategy, go to rsrlinks.com/buydown. That's rsrlinks.com/buydown. We'll walk through your scenario together on a Zoom, figure out exactly what a permanent buy down would do for your monthly payment, your liquidity, and your long-term wealth picture. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to Mortgage 101, brought to you by rsrlinks.com rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, 38% of families would be broke in 6 months if a paycheck disappears. Yours does not have to be. We'll talk about that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Borrow Smart segment today being brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. Picture this. 6 months from today, one paycheck in your house is gone. The mortgage still shows up. The car payment still shows up. The groceries, the utilities, the kids' activities, all still showing up. But the income that funded them just walked out the door. That's a reality for nearly 4 out of every 10 American families if their wage earner died tomorrow. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. That number is not mine. LIMRA, the Life Insurance Marketing and Research Association, the leading research group that tracks the insurance and financial services industry, just reported that 38% of consumers say their household will be in financial trouble within 6 months if the breadwinner died today. 6 months, not 6 years, 6 months. And here's the cause of that gap. The American Council of Life Insurers says this average American family carries just $197,000 in life insurance. Median household income is around $59,540. Do the quick math. That's 3.5 years of income replacement. The recommended floor is 7. So the average family is walking around with half the protection they actually need on a debt load that includes a 30-year mortgage. Let me tell you why this is a mortgage conversation. Because most people do not connect the dots. When you signed your home loan, you agreed to a 30-year obligation. That mortgage does not care if you are alive. It does not pause. It does not slow down. So whatever life insurance you carry should, at minimum, match the size and the life of the biggest debt sitting on your kitchen table. So let's talk about 2 choices. Term and permanent. Same goal, very different tools. Term life insurance is temporary protection. You buy a window, 10 years, 20 years, 30 years. If something happens during that window, your family gets the death benefit. If the term ends and you are still here, the coverage just stops. There is no cash value, nothing accumulates. The upside is price. Term is cheap, especially when you are young and healthy. That low premium frees up dollars to pay down debt, build liquidity, or fund the kids' college. Permanent life insurance plays a different role. As long as you keep paying the premium, the policy stays in force for life. And it builds something called cash value, a reserve that grows inside the policy at a modest rate of return. I will be straight with you. Access to that cash value is limited, but these policies cost more. But for the right family, permanent insurance solves problems term cannot touch. Estate planning, wealth transfer, final expenses, equalizing inheritance for kids, funding a buy-sell agreement for a small business. Here's where strategy beats rate always shows up again. Most agents try to sell you a product. A certified liability advisor looks at the whole picture. Your income, your debts, your home equity, your retirement accounts, your kids, your spouse's career, your tax bracket. The right answer is rarely all term or all permanent. For most families, it's a layered strategy. A base of permanent insurance to cover the things that never go away. A stack of term insurance on top to cover the temporary stuff. The mortgage years, the college years, the income replacement years. Let me walk you through a generic example. 40-year-old couple, 2 kids, $650,000 mortgage balance, both working. They might layer it like this. A $1.5 million 20-year term policy on the higher earner. A $750,000 20-year term policy on the other spouse. And a small permanent policy on each, maybe $250,000 to handle final expenses and estate equalization down the road. For a lot of healthy 40-year-olds, that whole stack costs less per month than what most households spend on streaming subscriptions and drive-through coffee. But here's the suitability question. How do you know what is right for your family? You start by knowing your numbers. What is your real income replacement need? What is your true outstanding debt? What is sitting in your 401k and IRA that your family could actually touch? What does your household budget look like if one paycheck disappeared tomorrow? This is the gap that quietly crushes most families. They do not know the numbers, so they guess, or worse, they buy whatever the agent put in front of them. One more data point worth sitting with. In 2023, more families bought permanent policies than term policies, but term accounted for roughly 72% of the face amount of all policies issued. Translation, permanent is being sold one policy at a time. Term is doing the heavy lifting on actual protection. That tells me a lot of families are getting sold the wrong tool for their primary need. Now, here is where my lane and the insurance lane connect. And this is the piece most homeowners completely miss. For a lot of families, the reason they are underinsured is not desire, it is cash flow. They cannot find another $200 or $300 a month in the household budget to fund the right coverage, but they have equity sitting in their house doing nothing. If you're a homeowner, there may be a way to use that home equity to help finance the life insurance strategy your family actually needs. Sometimes that looks like restructuring the existing mortgage to lower your monthly outflow and redirect the savings into premium. Sometimes it looks like a wealth builder loan, which is a first lien home equity line of credit that calculates interest on the average daily balance and gives you the flexibility to fund premiums while still attacking principal. Sometimes it's a different tool entirely. The point is this. Your home equity is one of the largest assets on your balance sheet, and it can be put to work protecting the people you love instead of just sitting on the sidelines. That is strategy beats rate always in real life. Now, let me be very clear about my role here. I do not sell insurance. That's not my lane. What I do is help you build a household strategy that tells you exactly what kind of insurance, how much, and for how long, and then I help you figure out how to fund it. When the strategy points to a coverage gap, I can introduce you to great insurance agents I trust in this market. Independent professionals who shop your situation across multiple carriers and put your family first. No pressure, no quota, just the right tool for the job. So here is what I want you to do this week. Know your numbers, your monthly budget, your real cash flow, your assets, your debts, your credit, because you can't pick the right insurance, you can't pick the right mortgage, you can't pick the right anything until you can see the whole board. I offer a tool for exactly this. It's called Key Steps. It's a free dashboard that helps you track your credit, your budget, your household assets in one place. Go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. Take a weekend, plug in your numbers, finally see your full financial picture. Then let's talk strategy, not just premium. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. So let's see if we can find some things to give away to you today. If you're thinking about your household strategy, no time better than now to look at the two-step, rsrlinks.com/two-step. We look at where your household debt is right now, your blended household interest rate, see how we can modify that to save you some cash flow. And 6 to 12 months from now, if rates are lower, we redo it again with a no-cost loan. If you're out shopping to buy right now and you've already got quotes from other lenders, we will give you a free second look. rsrlinks.com/2ndlook. Kind of like rsrlinks.com/second look. rsrlinks.com/2ndlook. You send us over the loan estimate you've already got. We've put it into our system. You might have a great deal, and we'll tell you. There might be some shortfalls there, and we'll tell you that as well. We already told you about the buy down program earlier in the broadcast, rsrlinks.com/buy down. So make sure you go and take a look at that one. And if you're thinking about shopping right now, rsrlinks.com/certified buyer. rsrlinks.com/certified buyer. That's our 5-step process to get you certified to buy a new house as soon as possible. And if you are a homeowner, if you don't have a trust, well, if something happens to you, let me know if your family gets any kind of a thank you note from the state, because they're the ones that are going to drive your estate plan. Go to rsrlinks.com/estate, ESTATE, rsrlinks.com/estate. As always, we ask that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.